You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you from Santa Barbara, California. Today marks about, 2 months to the day since my COVID-19 diagnosis, and I'm happy to say that I feel like I have finally recovered. Now, I'm out of shape. There's no doubt about it. These hiking trails that I used to do with ease are not so easy for me right now, but I don't know if I can any longer blame any illness for that, but I do think I am out of shape because of my long hiatus from the trails. But the good news is I think this thing I'm done with it. And I'm also happy to know that it seems to me that this thing is getting close to becoming part of our history. You know, the recent announcement from the Biden administration that the COVID-19 vaccinations, that everybody should be able to get it by the end of May, is pretty exciting to me. Now, hopefully we don't go screw that up in the meantime. Obviously, there has been the recent decision in Texas to pretty much stop the mask mandates and any kind of limitation on businesses, which I don't personally think is a great idea because I think, gosh, we're so darn close to the finish line. Why put any kind of risk to it in terms of having a significant bounce back in disease? But hey, I'm not Texas. I own plenty of property in Texas, but people in Texas do what they're going to do, I guess. To me, again, it just seems like we're so close, and that's what I'm hopeful about. And I'm looking forward to the fact that I think that hopefully by the fall, life will start to really look potentially normal. And that's really exciting to me. I think I know you have too, but I have had enough of this pandemic life. And anyway, listen, it makes me think about life in general and how it's not long enough to take advantage of the wisdom that comes with age. I mean, think about it. Obviously, none of us were around to see what it was like back in the pandemic of the Spanish flu 100 years ago, but it certainly would probably have given us some insight into what life was like then. This whole thing, life in general and our ability to gain wisdom through living, it's really kind of a cruel joke of nature if you think about it. I mean, I remember actually not too long ago, maybe a year ago or so, that there was a young syndicator who's, in the podcast ecosystem telling me that he thought that experience was overrated. And to me, that's easy to think when you are indeed young and inexperienced. Indeed, experience does matter. I can tell you that from experience. Experience does matter because although history may not repeat itself, it certainly rhymes. And that is, when it comes to your profession, when it comes to anything that, within a period of time and you've been through a cycle or two, you just have a little bit more insight compared to someone who's not. Luckily for me, I'm not that old yet, although, sometimes I certainly feel like it. I'm seeing patterns, though, really that I can identify being through, a cycle or two now. I can see patterns in the economy and investing that, I think my younger peers who are just starting out now probably can't. In fact, I see how these patterns come to fruition and how it is critically important to understand them. And that has made me want to learn more about history in order to compensate for those things that I have not yet experienced or seen. And to me, that's part of wisdom, is trying to understand what it is you don't know and plugging those gaps. So anyway, this, unique type of intelligence that we gain is what is called wisdom. It's what we get over time. So we get from our experiences. It's hard to understand the importance of this kind of intelligence when you're young. I mean, I still remember my father telling me things when I was a teenager that I completely blew off as nonsense that I realized later in life were profoundly true. This is absolutely the case. I remember asking my dad what was important about investing when I was in high school. And this is before Rich Dad, Poor Dad, right? And my dad, who is still an investor, is still a real estate guy, back then said that all he really cared about was cash flow. And I guess I didn't really even process what that meant. But then years later, I read, Robert Kiyosaki's book, and all of a sudden I was like, cash flow, pure genius. Now, and then realizing that, my dad was talking about that about, 15 years earlier to me. Why didn't I listen then? Anyway, these days, though, I am old enough to understand the value of wisdom. And when someone has been around longer than me and has some of that, golden wisdom to share, I listen. Because for me, and I think for anybody who really understands, wisdom is priceless, and I, for one, cannot get enough of it. And listen, it may not be right, it may not be wrong, but it is perspective. And getting somebody's perspective who has more of a panoramic view of history and experience is invaluable. Now, my friend Russ Ray, he doesn't look that old. And, I'm not going to say he's old, but he'll tell you he's been around for a while. And boy, does he have a lot of history and a lot of things to share. And I always love talking to him for that reason. And I think you're going to enjoy it too as we discuss what's going on in the world these days and with the pandemic and real estate and all these things when we come back after these messages. Welcome back to the show, everyone. Today, my guest on Wealth Formula podcast is one half of the dynamic duo that makes up the Real Estate Guys Radio, Russell Gray. And Russ was on the show actually not too long before COVID started, so it's an interesting perspective. And at that time, he was telling us a little bit about life after loss, as he had a major change in his life. And then COVID hit shortly thereafter. But Russ, welcome back to Wealth Formula Podcast.
Thanks for having me, Buck. It's good to be back, and congratulations on your show and your success.
Thank you.
I'm very proud of you.
I appreciate that very much, and it's been fun to share that with you. And you guys had a big part in my, you and Robert had a lot to do with me sort of starting out in the podcast world, ultimately getting involved with real estate in the way I am now, and I definitely appreciate that. Listen, I want to, it's so interesting to me. We were talking offline here about, you commented that you were old enough to see a lot of these things happen in this country. And I always look at you and I'm like, you're not that old, but I think you age really, really well in context of what you were telling me, remember? So I want to put this COVID pandemic into context of all the things you've seen in your life. And I'm sure you've done that yourself in a way, is to look at, your life and what's happened in this country and all these things that you remember. How do you think about this right now?
It's interesting. We're mutual friends with Chris Martinson and Adam Taggart over at Peak Prosperity. And Chris was really on the front end of paying attention to this. He had a list of almost a dozen different things that he was tracking, one of which he felt could trigger a chain of events. And I think he said number 5 on his list was a pandemic. Well, it was never on my list. And so when he called me and said, hey, are you tracking this coronavirus thing? That's what they were calling it back then. And I said, well, I've heard a little bit about it, but I'm not paying attention. He goes, well, you need to pay attention because it's going to be big. And I said, okay. Well, at that time, I was 1 month removed from my wife dying, and I was planning her funeral arrangements, and I had a lot of other things on my mind besides that. But in the back of my mind, I was kind of paying attention to it. And then I remember got another phone call, and somebody said, hey, I think it's time to start stocking up. And I waited just 2 weeks from the time I was told that. And then I ended up going into a grocery store, and I was married for 41 years. my shadow never darkened the door of a grocery store. So I kind of was surviving on what was in the house and what my kids had bought, taken care of me when they were here. And so I ventured out, and the cupboards were bare for a lot of things. Yeah. And it was really quite amazing to me. And so then I thought, well, either this thing is very, very real, which I need to take seriously. So I got serious about my health. I was already serious about it. I got even more serious when my wife got sick. And then when COVID hit, I got even more serious than that, and started really paying attention to building my immune system. But I also started, working on developing a deep pantry, and then developing a real understanding. So one of the first things Robert and I did was we pulled in some cards that we have, because we, over the years have built some really great relationships, as you know. And we put together a COVID-19 panel, and we interviewed Richard Duncan, who is a PhD economist, former advisor to the IMF, Daniel DiMartino Booth, former Fed insider, Art Berman, oil guy who really isn't trying to pitch oil or defend oil, but just get you to understand what oil is and what it means to the economy and the dynamics that really drive the price and supply and demand and all that kind of stuff. We had Peter Schiff, of course, who was our most popular guest by far. I mean, nearly 900,000 views on his video. It was insane. So we put together this whole group of folks, and we just asked them, what do you see? What are you hearing? What do you think? What should we be watching for? And we put all that up on our YouTube channel. So it's still there. And a lot of it is still very, very valid. But to me, the first thing was just to start to listen to people and get a 360 on people that were qualified to have opinions from maybe different perspectives. And it wasn't consensus necessarily. There was some, but it was just that beginning of getting your eyes open. So it kind of started with that. And then, from there, it was about the reaction. Is this reaction that we're getting from the authorities, is this valid? Is this normal? This isn't the first time we've had threats of diseases. And then the question is, not so much from a policy perspective. I learned a long time ago that politics and investing don't mix, because you have your political preferences, your political opinions, your coulda, woulda, shouldas of what you think they should do. But at the end of the day, it doesn't matter, because they're not asking you. You just have to look at what they're doing and ask yourself, okay, based on what they're doing, what's likely to happen next, and how can I position myself? And so we put a lot of our emphasis on that. And I think we may have talked about some of that the first time. I don't know. But I'm still pretty much just watching that rollout. It's a slow motion train wreck. It doesn't mean they won't save it, but there's still a lot of wheels in motion right now that I think any investor needs to be paying attention to.
How do you think that this, in terms of real estate, obviously you're real estate guys, what surprised you during this last year, if it did, and why, and what do you think happens next?
Well, I think one of the things that maybe was surprising was how strong the real estate market, especially the housing market, was. It wasn't surprising to see retail implode. That was happening before. This just accelerated it. It wasn't surprising to see industrial do well. That was already happening. I think that seeing the shift out of going to work in the offices with the lockdown and the I think the move to remote working, and that eventually became fairly permanent. I think a lot of companies have really embraced that as part of their permanent go forward plan, absent disease or not. I think they've just realized, boy, we can offer our people a lot better lifestyle. We can have more affordable payroll. People can live really where they want to live, which is more affordable than these expensive urban areas. So I think how badly some of the real major downtowns like a San Francisco or a Manhattan got hit was probably a little surprising, but how really, really strong the housing market turned out to be. And there's a lot of factors there, but I think that was a little surprising. You'd think with all of the uncertainty in the economy, all of the shutdowns and layoffs and business closures and failures, you would have thought that it probably would have been a little bit tighter than it's been. So that was a little bit of a surprise.
Yeah, no doubt. I think that was one of the things that when it all started, I think everybody was worried, and we've got in our investor club, now $500 million of multifamily real estate under management, and it was a little bit scary at first. But what was interesting is by I'd say, a few months into it, it was pretty clear that this thing was a lot more robust than we thought it would be in the multifamily sector. And I think part of the fortune that we had in our group was because of where our real estate was too, right? I mean, it was working class Texas and working class Arizona. I kept hearing, because I live in California, as you know, about people who owned real estate in Los Angeles where people were just refusing to pay rent. We didn't have that. We didn't have people refusing to pay rent. They just did, and did whatever they could to make it happen. So we did have maybe a month or two of some challenges, but man, it came back and it's been extremely robust. And I think it surprised, even guys like Kenny McElroy and stuff like that were really thinking this was going to be doom, gloom, defaults. And well, it seemed like it was for retail. It was for office, but it wasn't for us. And the curious thing that we're seeing right now on the on the multifamily side for us, and I'm sure you can talk to this too, is that a lot of that big money that was focused on office and hotels and retail, they're trying to find a new home. And they're headed toward us.
Well, yeah. I mean, and anytime there's trauma in financial markets, money looks for a safe haven.
Right.
And real estate, the right real estate in the right markets is that safe haven, And I think that if you go back, even just in stock trading, the basic premise in stock trading is when things get choppy, focus on consumer staples, focus on the basics, focus on the things that people absolutely need in good times and bad. Well, obviously, housing fits into that. So there may not be home building going on, although there is, but certainly existing stock is going to have demand, especially if you get the market right. And so I think that that natural gravitation of trying to figure out, okay, what is the sweet spot in housing? Well, it's affordable housing, and I think that we've all seen a pretty big spike in demand for mobile homes, and mobile homes is kind of a fixed commodity. It isn't something that they're building a lot more new of. And basically what's out there is what's out there, and people are competing over it. And so I think there's a lot of competition for that. But multifamily is something that can be built to add demand. It's something that, institutional investors like. It's bread and butter. And the other part of it is that it's got great governmental support in terms of subsidized financing, Fannie, Freddie, that type of financing is available. So when you're interested in being in an essential asset class and you're trying to find a space in real estate, multifamily is the natural place to land. And it's not surprising at all that institutional money would flood into it, which, is good and bad. It creates opportunities for some people. It creates difficulties if you're out there looking for deals. Yep. But there's always crevices, places to fit in. So you have to work harder in a market like that.
Yeah. Yeah, definitely. I mean, it has its good things and its bad things. I mean, it's great for the real estate that we already own. I mean, the value's gone way up, but it is harder to find new opportunities that work and that pencil out. So now, perhaps being optimistic, but I will say that I do think, it looks like vaccinations at least will be, available to everybody by the end of May. The end result being that mostly, I see this pandemic largely becoming something that we can start, seeing an end to, hopefully by the fall is my guess. And, for me, when I look at, all of the money that's coming into the economy right now, in terms of QE, in terms of government spend, government helicopter money, et cetera, and then you put that into context of incredible built up demand for, doing stuff, to me, it looks like the economy is going to boom, right? It just looks like we're going to have a serious boom, probably a bubble-ish boom. But, there's another possibility there, and because of the incredible amounts of money going in, which is inflation with basically higher unemployment, which is known as stagflation. And I know that's something you've been concerned about. Do you want to talk a little bit about that?
Yeah, stagflation is a concatenated word that has kind of made its way back into the lexicon these days, and it just means stagnant economy with inflation. Mm-hmm. And normally inflation is a byproduct of a robust economy, and you hear Jim Rickards talk a lot about velocity, although I've heard people in the Mises Institute say that velocity doesn't really drive pricing. I don't know. It kind of makes sense to me that it would. Jim's a pretty smart guy, and so when he talks, I listen.
Sure.
But he thinks velocity is a big deal, and that's just how fast does money change hands. So I think of currency, which is what what we call money, but currency, the medium of exchange, dollars in an economy, is like blood. And if you can think of the economy as an organism like a human body, and of course you have that background much better than me, but you know that the blood carries the nutrition, the nutrients, the oxygen to all of the cells. If you look at cells as individuals and you look at organs as organizations, collections of individuals, then that blood better be flowing. And if it's not flowing, then things start to die. They grow weak. And so when you lock down everything, it's like having a heart attack. The heart's not beating, the blood's not pumping. And, you can maybe give some strategic injections and things that they've been doing with stimulus. But at the end of the day, you've got to get things moving again. You've got to get people trading with each other, buying and selling and money moving around. The concern is that when you've been injecting through artificial means a lot of stimulus in order to prop things up, well, the heart's not beating. The minute the heart stops beating, you might have like too much in the system. And so you've got to deal with the threat of inflation at the same time that things are slow. And then you got to try to figure out a way to work yourself out of that. In the 1980s, coming out of the 70s, Paul Volcker, who was a Fed chair appointed by Jimmy Carter, but actually did the work with Ronald Reagan. And sometimes, presidents get credit or blame for things that the Fed is doing. And so, I always look at things from the Fed perspective a lot less than the political party perspective. But at the end of the day, they jacked interest rates all the way up, as you may recall, to over 21% prime rate. It was basically a great reset. The dollar began failing in the 60s. And we're talking, I'm working now with my grandson, one of my grandchildren, teaching him coin collecting. And when I was coin collecting, when I was a boy, I watched the silver come out of the coins. And so I remember that in the 60s. And so the dollar was already failing because of overprinting in the 60s. And so they kind of stole all the silver the way they had stolen the gold prior in the 30s. They did a little bit of a reset in 45 with Bretton Woods. They did another reset in the 60s with the Coinage Act. But the big reset was in 1971 when Nixon finally defaulted on the gold standard and all those dollars came home to roost. That's where we had really bad inflation. Nixon instituted price wage controls. And so if you're not old enough to remember this, the president of the United States, by decree, made it illegal for any private citizen, private business to raise their prices of their products or give any of their employees price or wage increases. In the United States of America, in the land of the free, right? This is what happened, right? And so now you look at COVID-19 and you see these same draconian type of dictates coming from people where they're shutting down businesses and they're telling you don't have the right to conduct business and make a living. And it, you may agree that the price is worth it, that the risk is worth it. But at the end of the day, and you can debate whether they have the authority to do that or not. But the fact of the matter is they did it the same way Nixon did it. So there's some parallels. And that's the point that I'm making. There's some parallels. Sure. He sent Kissinger off to Saudi Arabia and they cut the deal with the petrodollar, what became the petrodollar, which is basically all oil worldwide now, largest commodity in the world, being settled in dollars to create demand to soak up some of that excess with the float. You get all the worldwide float now occupying dollars. That took some of the excess off. We also had to raise the price of oil so that it would suck up more dollars. And this is where, I call into question some of the things that I was told in the 70s about we were going to run out of fossil fuels by the year 2000, which obviously is ridiculous. We had such an abundance of fossil fuels just last year that the price of oil dropped to negative $40 a barrel.
So much for peak oil, right?
Yeah, so much for peak oil, right? But so if it wasn't true at the time, then maybe it was contrived in order to create a siphon for all those excess dollars. And so that's something that has to happen from time to time. My point is there was a great reset then. It wasn't called that, but today there's been some talk about from the World Economic Forum and Davos and Klaus Schwab talking about this great reset, this idea that, the dollar has reached the end of its shelf life. And it's near failure, and there needs to be some type of a reset, either to take the world off of the dollar as the world's reserve currency, something I've been watching since 2013, or they need to find a way to reset it. Rickard says, "Hey, it's simple: just reprice gold at $15,000 and do what you did before." Okay, well, maybe that's what they're going to do. Maybe they're going to introduce SDRs, which is something Rickards has talked about, and use that for international trade, and the dollar will just become like any sovereign currency for a specific country, but not the world's reserve currency. Maybe that'll happen. I can't imagine a scenario where they're going to jack interest rates up to try to reset the dollar. There's just way too much debt. It would implode.
Right.
So I don't exactly know how it's all going to end, but I know that rising interest rates is probably not going to be the formula for containing inflation. And so my thesis, and that's all it is that perhaps some of the slowdown is designed to reduce velocity to hide the inflation due to all the money they've printed. And there's no question about how much money they've printed since 2008 in order to buy a little time to execute this great reset. So that's what I'm watching. I can't say that I have even a preference about how things happen, but I'm still remain very concerned about the dollar in the long term. And I think people have to have hedges against that. I think being short the dollar is probably better than being long the dollar. Real estate is a great way to do that because you can acquire the best debt there is, which is the best way to short the dollar, and then acquire the income streams and the tax breaks to service it if you pick the right market and the right property. And then you just have to kind of take a wait and see approach and be a little bit nimble and see what they're going to do. And, now we've got a new administration and so there's a new sheriff in town. That's driving some energy policies, which are causing the price of oil to go up. And oil and the economy are interlinked. I mean, it takes energy to do business, and it's a cost of every product, every service that is offered. And so when oil prices go up, that's built into everything. And then, when you get specific to things like building, lumber, I think, is at an all-time high, or it's experienced, substantial inflation, if you will. Part of that is supply and demand. Part of that is just good old-fashioned inflation, but it's a major component of home building. And so you've got those components of cost in addition to the energy. And so you've got to say, well, that's bullish for housing prices long-term because you can't get a new house out of the ground for anywhere near what based on the existing inventory. It's going to pull the existing inventory up.
Yeah. It's interesting when you read or listen to Jim Rickards, you listen to some of the others in the space who are very concerned about what's going to happen, various different projections on how the proverbial shit hits the fan, whether it's some kind of Bretton Woods reset, whether, some sort of gold standard, et cetera. A lot of times that leaves investors, mom and pop investors, just people who are listening to this show, it leaves them in a situation going, okay, well, that sounds like a bad thing. What do I do about it? And so, my philosophy on that has been, what we're really talking about most of the time here is debt and the dollar. And so the best thing to do is, as much as possible, probably stay out of the dollar and be in hard assets as much as possible. What do you make of that?
Yes, absolutely. In fact, I'm working on a video series right now I call Precious Equity, and it's, based on a basic, very simple investment strategy and investment thesis, which is that real estate is perhaps in a bit of a bubble. You've got interest rates maybe as low as they're ever going to be.
Sure.
And the opportunity to go short the dollar by taking out debt and harvesting that equity, and then the arbitraging it, and then trying to, in this case, convert the equity into gold. If I'm going to have equity on my balance sheet, would I rather have it in the form of equity in real estate or equity in gold? Well, I'd rather have the gold personally. I think, based on where the gold price is relative to how everything else has moved and its history as a hedge against a falling currency. And I think there's a real opportunity there. So either just to kind of state it simply, you'll get it right away. You borrow a couple $100,000 out of a property that's equity rich at 4%, you take half the proceeds and invest it at 8%. Now you're cash flow neutral. You've basically straddled. I took a loan and made a loan, and then I take the other 100,000 that's free and clear, take 50,000 of it, open up a qualified retirement plan, and drop it in there, and then purchase precious metals with it and put those precious metals in my safe. Now, those precious metals, that gold and silver, and I guess let's just call it gold for now, is owned by my qualified retirement plan, which is a pretty strong asset protection ownership structure. In my physical possession, I have no counterparty risk, and it's completely outside the system, which means even if the system fails, I still have that gold. That was my real estate equity, but now it's my gold. And I picked up a tax break along the way. I wait till the calendar rolls over. I do it again with the other 50,000. And now I've picked up $40,000 in tax breaks. I've got $100,000 of gold in my qualified retirement plan in my safe that used to be on my balance sheet in my real estate, and I'm cash flow neutral on the whole trade.
So that's a
strategy.
This is based on the idea, your idea that real estate's in a bubble, right? Because I think my question would be, well, how is owning real estate necessarily going to be different than owning gold? To the extent that I think of gold as a hedge to the dollar and to inflation, but in that regard, so I think of real estate the same way.
Well, so real estate is a hedge against inflation. In other words, when you own anything real, it's going to retain its relative value no matter what the currency is.
Right.
And it's going to have real world utility no matter what's going on. That's why you want to own things that are real and essential. So that's number one. When you add leverage to the mix, debt puts you short the dollar because you're borrowing future dollars and buying today's assets. So real estate allows you to own something real and go short the dollar. So adding debt is what I want to do. And then I use the income and the tax breaks from the real estate to service the debt. If it's a little tight, then I can actually buy debt or make loans, high yield mortgages, in order to supplement some of that income without any of the same types of risks that I have, the capital risk. In other words, I'm not having to go all in. True arbitrage is where you take two sides of a position and you make money on the spread. It's like a bank. You go into the bank and you make a deposit. They pay you 1%, and then they loan it back to you at 6%, and they make 5% on the spread. And then you add in fractional reserve, and they probably make 60% on your savings or whatever the number is. I mean, they do well doing that. You can do similar things. You don't get the benefit of fractional reserve, but you get the ability to do that. The thing about gold is without leverage, gold is just a hedge. It retains value, but if you want to make a profit without having to get the supply and demand and timing and imbalances right, then you have to add debt to the mix. And see, that's where I say real estate is the best vehicle for acquiring debt. And then if you can use the equity in the real estate to acquire gold, now if you get a currency collapse, it's going to be reflected more in the gold because gold doesn't have leverage built into the pricing. And so then you can use a portion of that appreciated gold to settle that debt if you wanted to. In other words, if I took $50,000 of gold out or equity out of a property and bought gold at $1,500 an ounce, and it's more than that today, it's $1,800, and it were to go to, say, $3,000 an ounce, which is what Bank of America last year projected it would be, maybe by the end of this year, we'll see. But let's say that happens. Now that $50,000 of gold would actually convert back into $100,000 of dollars that you could use to retire the debt. And that's profit. That's real profit, because now you own more of the real estate, but you use the appreciation on the gold to pay for it. And you still got the appreciation on the real estate. You got to appreciate both assets at the same time. Right. If I leave the equity in the real estate, I only get the appreciation on the real estate. But if I pull the equity out and I either buy another piece of real estate, which you can do, except usually the best time to pull the equity out is not always the best time to buy the real estate. Although you can find deals, you just have to work harder for them. But then you're also all exposed to real estate, whereas maybe you want to diversify. So gold would be another way to hold equity. But the point is, now I get the upside, if you will, in terms of dollars, the inflation hedging power of the gold and of the real estate for the same equity.
Yeah.
And that's the key, is you have to find a way to outpace the inflation, not just hedge against it and stay even. If you want to grow your wealth, you got to outpace it.
Right. Yeah, definitely. I think the thing I was trying to get at was really the gold aspect of this. For me, I'm not as much of a gold bug. I'd rather buy more real estate, but functionally it's doing sort of the same thing. I think your point is that, if you want to get exposure to something else that also has resistance to inflation and, the potential for the dollar to crash.
Well, Buck, let me give you 1 minute of the case for gold in this case. All right. And the reason is because real estate is not liquid, gold is. Real estate equity is, you have to qualify to get the loan, and it has to be a positive lending environment, whereas it's easy to borrow against gold because you're lending against an asset. And the other thing is, real estate is often only going to trade in whatever currency it's either going to be the dollar or whatever currency where the real estate is located. For most people investing in the U.S., it's only going to be dollars. Whereas if you have it in gold, you can pivot into any currency you want, right? I could sell gold and get yuan. I could sell gold and get yen. I could sell gold and get, whatever.
Sure.
So there's a case to be made, and it's portable. And you can hide it. There's some asset protection, there's some counterparty risk. There's some advantages to it. I'm not saying that it's the only thing you want to have in your portfolio, but I do think that a lot of real estate investors, are so all in on real estate that they don't understand that these other real assets have a place. And it's not, a lot of people just look at gold as insurance, but if you combine gold with real estate, it actually can grow wealth. So anyway, that's my 28 cents on that.
Yeah, no, it makes sense, and it's a reasonable way to go. Let me pivot back to the idea of stagflation now. So now let's look at the next year or two, because I think what you're talking about when you're talking about some of the reset things happening, I would guess that you're thinking of that as something in more over 5 years from now. What happens in the next year or two?
Well, so I don't believe that they can allow interest rates to rise to any significance. But the problem is, to try to keep the interest rates down, they have to print dollars and buy treasuries, which exacerbates the inflation. So if they leave the economy locked down, you continue to have stagnation. And so I think they're going to try to open the economy up slowly so that it doesn't take off. I believe the only other tool left in their toolbox, the one that we're likely to see, is going to be high energy costs, which they're driving towards now. I think energy policy is partly not driven by environmental concerns, but by dictating the impact on the economy and protecting the dollar. And that's just my paradigm. The way I look at the world, I just look at the money, and I think the money tells maybe not the whole story, but a big chunk of it. And then the other thing is taxes. So high energy costs and taxes are two things that I would see coming as a way to hide the inflation, and it will have a metering effect on an economy that's trying to open up and go gangbusters. So I go back to the idea that if you have real estate, And as long as these tax breaks, as long as the best tax breaks are found in real estate, I think when people go looking for tax shelters, more money is going to find its way into real estate as more people are out there making the case. You're a syndicator, some of your offerings are structured primarily with the benefit of offering tax breaks to your high tax professional investors. They have a tax problem. Right. They're not even trying to build wealth as much as they're just trying not to be bled out on their incomes. And so I think that taxes, I think we can expect higher taxes, and then higher energy costs will have a drag on the economy. They will drive people, they will make working class people poorer because prices of goods will go up and the cost of their gas and their, energy, heating, transportation, all that will go up, which will drive them more and more into affordable housing. So if you're focused in the affordable housing space, in affordable markets, especially markets that have low taxes and, landlord friendly, all the basic stuff, business friendly, all the basic stuff that you look for in real estate investing, you get to go short the dollar, take advantage of the low interest rates. You get to get your disproportionate share of people who are moving down because they're being pressured by the taxes and the insurance costs. You get to pick up the not taxes and energy costs. You get to pick up the tax breaks. And you're probably going to be the recipient of an influx of capital, other people who are seeking to do the same thing. So if you get in early, you're probably going to see some appreciation. The risk, of course, that you run is that they do let interest rates run or they lose control. Now, if that happens, then you just have to make sure. I'm still a big fan of locking in the longest possible terms you can, 10, 20, 30 years if you can on your loans. And doing everything you can, to get interest only and not prepay anything, keep the equity out of the property. So that's kind of, what I'm watching for is energy policy and tax policy out of this new administration, a combination of, what the Fed is going to do to try to let the economy restart without overheating.
Yeah. So speaking of the new administration, some of the legislation that, hasn't really been introduced yet, but has been suggested include things like, getting rid of the 1031 like exchange and that kind of thing. These things, in talking to Tom Wheelwright, who you and I both know, he's my CPA, but, Tom has said about this before and that this has been introduced multiple times, and it always fails for one reason or another, and it relates to the fact that there's a lot of implications to eliminating 1031 exchanges. What do you make of this? I mean, is this just another round of, trying to attack some of the real estate benefits that really, are not going to stick?
Yeah, I think anytime you go into a negotiation, you put a bunch of stuff on the table, and then you have a handful of things that you're willing to take back, to give away in order to get the other side. Now, the way the Congress is set up right now, they don't need to give away a lot. So I would say that there's a chance that, this particular Congress might actually take away some of those benefits. But I would say they would be the last to go because the constituencies that are affected by that are wealthy and they have a lot of influence.
Right.
And so I just don't think, I think those are things that get talked about in order to get people to the table, in order to have things to talk about when everybody's paying attention. And then when the thing actually gets passed, a lot of these things, just end up on the cutting room floor. So that's been history. That's the way it's pretty much always worked. I can't say just because it always has, it always will. But, and again, that I go back to this idea that as long as you understand the debt side, it's still possible to move equity around. You just can do it through debt. You don't need to do the 1031 tax deferred exchange. And you can still acquire new depreciation schedules by using the harvested equity for down payments on new properties. I think the biggest thing is you want to be really thoughtful about the markets you invest in and the properties you invest in, and just be prepared to be in them for a long time.
Yeah. Well, it'll be interesting too, is the other thing that I had been thinking about is if there was an end to 1031 exchanges imminent, it would probably create some significant movement even within the real estate market. People trying to, get their last 1031 in before the laws take effect and all that. It would be kind of crazy to see. But anyway, listen, Russ, it's been really fun to catch up and talk. Tell us a little bit about what you guys are doing. You guys have got tons of events all the time, and obviously those have changed substantially. I remember real estate guys having some kind of live event like almost every month or two. And so how's that going, and what are the plans moving forward here in the next year?
Well, 2021 was the year of 2020 was the year of learning how to do virtual events. Yeah. And we did it fairly successfully. We did our 2 Secrets of Successful Syndication seminars and all of our club meetups, which you're familiar with. We did our annual investor summit, not at sea, but on the screen. It was good. People enjoyed it. I think that we got a lot out of it. Definitely not the same. We opened up this year with our Create Your Future Goals retreat live in Dallas. So we had 150 people. It was great, very successful. We are doing our Secrets of Successful Syndication event at the end of March. We're sold out. So
is that live, or is that
it's live? It's live. Mm-hmm. Robert has been back doing his Belize field trip, so he's done 1 or 2 this year. He's got another one on the books. We are doing our investor summit this year, not on a cruise ship, but live at our resort property in Belize. And so you have to get a COVID test coming in and out of the country. But other than that,
when is that? When is that? Right?
That's in June.
Okay.
So Peter Schiff is coming. Kenny McElroy, you mentioned, is coming. Tommy Hopkins, I believe, is confirmed. We still have a few people we're working on. We're hoping, with the way states are opening up, that, sure, some of the restrictions, but, Belize was closed for 8 or 9 months, the borders. You couldn't even get in or out. I don't think they can do that again. They just can't afford to. So sure. I think that the financial realities of these lockdowns, even if they are medically justified, I think at the end of the day, you're going to have to pick which devil you want to dance with. And I think at this point, people are willing to risk getting sick, or at least, letting people make the choice, and people who are at risk and people who, have, whatever preferences they have, they can choose to stay home. But there's going to be other folks who are a little bit more intrepid, more adventurous. We got a lot of people signed up to come do that. So we're running our life right now in 2021 the way we always did before. So Texas is just opened for business. So there's no mask mandate. There's no restrictions. The hotels are still having some precautions, but I think that those are going to unwind pretty quickly now, based on the state's leadership in that regard. So again, you may agree or disagree. I'm not saying it's right or wrong. I'm just saying it is what it is. We like getting together with people. I've been doing it since last October, and it's been a lot of fun. I don't enjoy traveling as much. I try to curtail my travel. I used to really look forward to it, but I'm not a fan of what you have to go through to get on a plane and be on a plane, and especially to cross borders. So, but other than that, yeah, we're doing that. We are more active. We're continuing to do virtual type things more often, where we get people together and we talk. We built out our YouTube channel to capture some of that. And so, we added. So, all in all, I think 2020, as challenging as it was good, because it forced us to learn to do some new things and branch out in some new areas and reach some people that we wouldn't have otherwise reached. And, 2021, we're going to keep all that and add or go back to the things that we were doing before. So we're busy and having a good time.
That's great. Russell Gray, everyone, with the Real Estate Guys Radio. Check out the podcast. Also, it's therealestateguysradio.com.
No, it's
right?
realestateguysradio.com. Realestateguysradio.com.
I know. We had to get this right because there's lots of copycats out there.
Yeah. Well, we're the old guys for sure. We're the originals.
Yeah, look for the old guys, the originals, the oldest guys you can find, and it'll be the right one.
That's it.
Anyway, thanks again, Russ. We'll look forward to having you on again sometime.
Thanks for having me, Buck. It was awesome.
Welcome back to the show, everyone. Hope you enjoyed it. It's always fun to have Russ on the show. And listen, I don't necessarily agree 100% with everything that Russ is saying. And, he has a slightly different perspective than me. I do tend to be a little bit more optimistic than some and about the economy. But again, Russ has tremendous, he has tremendous perspective and wisdom. And so it is always of great value to listen to somebody like that, and see what they think that's going on. What does this remind you of? Things like that. Somebody who not only who can say that they think that we're going to have stagflation, who's actually lived long enough to see a world in which there actually was stagflation. I was alive during the last round of stagflation, but I was a little kid, so I didn't really know what was going on. Anyway, that's it for me this week on Wealth Formula Podcast. I hope you enjoyed it. If you did, make sure you go to wealthformula.com and follow the links to give us a 5-star review. This is really important. If you think I deserve it, give me a 5-star review, say something nice. This is how we get up in the rankings and continue to have very good guests on the show. That's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.